Today, I'm going to show you how to make an 18x on Solana with minimum risk, maximum upside. Imagine if you could risk 3% of your money to make 50% on your money. Well, that's the art of trading, the science and the art combined, and we're going to cover that today with high probability but never certainties. So if you like today's content, like, subscribe, hit the bell notification. If you don't know me by now, my name is Jiggy. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro, been featured in the best-selling book, High Probability Trading Strategies, back in 2008, where I only used to focus on currency, but now exclusive on cryptocurrency. So let's dive straight in. In yesterday's video, we covered Cardano, and I got a lot of insights from your comments, and I didn't realize that a lot of people haven't been taught the basics, right? The basics of entry, exit, and everything else. So today we're going to focus on Solana. We've been following it for a while. We've got some textbook ABC setups, 1, 2, 3, 4, 5, etc., etc. So with Solana, we pegged this low back in, I think it was June. Was it June? Yeah, around June last year, we pegged this low, and then did this massive surge, and then a nice correction that we're finding right now. And then our last video, which was on around a week ago, less than a week ago, we said, look, we should anticipate the next leg. Well, now we're coming towards that end of that correction. So now when we zoom in, it looks like we got a 1, 2, 3, 4, 5 of a wave C, of a wave 2. Like, what does that mean, Jiggy? Typically, it just means it's coming towards an end of a correction that's got very high probability to do a reversal. We saw this exact same thing down here when the market was going against us, and we pegged this, and then it just surged. So Solana has that habit of doing these correct, clean, textbook Elliott wave and Fibonacci corrections. So what I want to remind you of is markets move in 1, 2, 3, 4, 5s, and then 3s, A, B, C. Right? This is so important that you see this. Normally, waves 3s are more impulsive than a wave 1. They're more aggressive, especially when this high gets taken out. It's very, very aggressive. Wave 4 is typically a profit-taking wave. Wave 5 tends to lose a bit of momentum. Then the market needs a big correction before the whole sequence takes off again, right? So where is Solana in context to this, to Elliott wave theory, to Fibonacci ratios? Where's the psychology of the market? Bang, that's where it is, right? Check it out. This is exactly where Solana is right now. We did a video again back in June last year where we pegged this low. It did a classic 2.618 wave 3. It did an ABC correction of a wave 4 and then a wave 5. And if you want to learn about how to do this, how to do it in advance as a leading indicator, take my free Elliott wave and Fibonacci masterclass is in the link below. But I've got some cool things to share with you today to give you a bigger edge. So let's jump into our live chart with Solana. All right, we're jumping into our live chart. So we've done a lot of analysis, right? I've just kept the chart nice and clean, cleaned up a lot of stuff. We just know that the market's at a 1, 2, 3, 4, 5, and then now it looks like an A, B, C. So we just want to now focus on a couple of things. So we don't, because sometimes when you got too many bits of information on the chart, it can become convoluted, right? We want to keep it nice and clean and clear. We got a wave, what looks like a very obvious now, wave 1. And keeping in mind that we did a video down here to project this wave 3 in advance and to project this wave 5 in advance. And you look back at the videos and we projected this typical correction in advance. So what do we look like we're seeing now from a pattern perspective? Well, it looks like we're now seeing a wave 2, right? A wave 2. And you would have seen this in the last videos, but it looks like we're coming towards an end of a wave 2. Now, we don't want to catch or try and catch a falling knife. What we want to do is wait for the reversal. So I'm going to show you how you can get in a high probability and minimize your risk. So in the previous videos, we've done some ratios. You know, what we said was this looks like a wave A, a wave B, and a classic wave C, which is called an ABC zigzag. Then we also said, if I just get rid of these lines, if I just zoom in, just a quick reminder, I said it looks like it's also forming a textbook wave 1, 2, 3, 4, and then a wave 5 of a wave C of a wave 2, right? So we've got 3 degrees of counts, right? So just so we're on the same page, you know, I cover this in the masterclass in some of my courses. We've got the macro degree count, which is the wave 2. We've got the intermediate, which is an A, B, C. So we're now looking at the C. That's an intermediate wave count. And then we are looking at the 1, if I can get this here, bump, bump. We've got the 1, 2, 3, 4, 5, right? There's 5 over here. So that's what we mean by 3 degrees of wave counts, right? We've got the C, the 2 of a C over 5, or 5 of a C over 2, right? That's what we're talking about here. And what that means is why that is important. There's many things that it's called a confluence of events. There's more than one thing telling us that we've got a high probability zone. So now we've got pattern, right? That's what we're looking at, pattern. Now we also did price, right? Fibonacci, price. I'm not going to do them again today, but we did them in the last video. There's key psychological ratio that says this is a high probability end of wave 2 zone. And we also did some time analysis as well. We measured wave A, projected it from the wave B high, and this was this zone over here. We haven't met, and we want to be aware of this. I'm just going to say it like this. We haven't, I think, let me just draw it again. I think I deleted it. Let me just draw it again. If we just look at the chart from here to here, this is the typical zone of a correction. The absolute minimum is normally 38, more common is 50, and then maximum is 100%. So we haven't reached, we want to be aware of this. We haven't reached this minimum and this minimum, which is more March and April. However, we have reached what's here. So we got pattern, we got price, we got momentum, which we're going to look at in a second. And our time analysis, we've got some time that says this is looking like it's coming towards an end. So now we want to put the probability in our favor. So what we want to do is the following. Let's just get rid of these lines. All right, so we're going to jump into a weekly chart. Weekly chart, top left. Right, what we want to see is the momentum. Right, what's the momentum doing right now? Look at this. Right, it looks like the blue line's about to cross the red. It's oversold, deeply oversold. So we should anticipate sideways to up for the coming few weeks. Right, that's the trend is your friend. Ride it until its end, until it reaches its bend. So the trend, the weekly momentum, the higher degree time frame tells us what's the major direction that we should anticipate, and we want to go with that direction. The wind's going to be in our sail, and we want to go with that direction. All right, so that's one. So then we're going to go, if I just zoom this back down again, boom, boom. And then we're going to go into a daily chart, top right, double click, bang. We've got a bullish reversal, right? There's 2 indicators here. This is the fast one. The settings here are 8533, and then there's another one. I'm going to pull both up. I'll show you both. There's the 13 and the 8. So what this basically means is, what the difference between the two are, this one is a bit slower and catches more the macro moves, and this one up the top is a bit faster and gets the intermediate. And ideally, you want both of them pointing in the same direction. So the slower one, it's got the blue line is in the oversold zone, which means we should be coming towards the bottom, towards the momentum. And the 8, the top one, has a bullish reversal. So that's a good indicator for us to say, okay, we can look to take a long position, and now we need to do a business management plan for Solana, right? So everything's in play. We go, okay, looks like a wave 2 low. Okay, so let's just do a projection first on what are we anticipating on a macro scale if this is a wave 2 low, right? If this is a wave 2 low and it holds, what do we anticipate? Well, typical psychological buying and selling behavior, I've done this one in advance, is if we measure wave 1, which is now macro wave 1, and project it forward and add times it by 1.618, this is the typical ratio. $504 for Solana, and then the 2.618 is up here, which is 763. This is typically when the markets expand, new money comes in, there's bullish buying optimism, especially if we break the all-time high up here, which is around, $250 thereabouts. If we break that, it just tends to take off a wave 3 of a wave 3, and we want to ride that wave. But at the beginning, I said 18x, right? And you might be thinking, if you've done the math, you go, what'd you get? Today's around, $88? Even at the top one, at 763, that's still not even a 10x, right? Because 800 or 89 times 10 is 890. You go, that's not even a 10x. Well, I'm going to show you. I'm going to give you a quick glimpse, and then we're going to do it in step by step. I've created this spreadsheet. For those of you that have my Fibonacci and Elliott Wave course, like when you do the masterclass, you can buy my course, and I break everything down from Elliott Wave, foundation, intermediate, advanced, and then Fibonacci, all the ratios, foundation, intermediate, advanced. I've added this to the course. There's a section called risk management that I've just added this to. I'm going to cover this because this is going to help us. We're going to plug in some numbers and it's going to spit out where should our entry point be, where should our stop loss be, what's the risk, what's the reward, what's the business plan, what's the numbers, what's the P&L, what's the things that we can't normally see that's not intuitive that this can help us with. So we're going to use this so we can just plug in the numbers so we don't have to keep pulling up a calculator, and I'm going to leverage this tool that I created for, especially if you got my course. If you got my course, this will be in the back end, but also it's going to be a great reference for us to get your thinking right. And so we want to be objective, mechanical, and non-emotional. Non-emotional, that's the key. All right, so now let's go into our business plan thinking. We go, okay, me and you, let's just say we're on the same page. We go, Jigger, looks like a wave 2. We got 1, 2, 3, 4, 5 of a wave C, of a wave 2. So we've got pattern. Weekly momentum and daily momentum to the upside. Trend is your friend, ride it until its end, until it reaches the bend. So we've got momentum, dual momentum, 2 momentum, 3 degrees of counts in terms of Elliott wave, 2 dual momentums pointing in the directions. And now we've got good probability in our favor. We've hit a 62% retracement. We've hit an alternate price projection, which is a wave A projected from a wave B. And we got a couple of other things. End of wave 5 target of a wave C. So we got some good Fibonacci price ratios, right? And then we got some time as well. When we say time, the main one is how long did it take for wave A to form, which is this time. And if we look at that from the top of wave B, we should see that we're in the range of the typical, because they tend to marry up. They tend to, wave A and wave C tend to have a direct relationship. So we're on the same page. We go, okay, wave 2 looks good, but that's only half of the equation. The second half of the equation is, all right, how do we make money from this? How do we make money from this with risking little? How do we make a lot by risking little, right? So we're going to do some just objective thinking now, objective thinking. Right, so once you've done your analysis, you can keep all the lines in play. But for today, what I'm going to do, I'm going to clean it up. I'm going to just delete everything because it's noise, right? We want to keep it clean, objective, mechanical. We go, okay, we're happy. We're in that zone. We're even going to get rid of this like this. I'm going to even get rid of this and this, right? So now we go, okay, we're on the same page, right? Looks like a wave 1, a wave 2, but we're coming towards the end. And if we can peg the low, we can make a lot of money, right? Make a lot of money. But we're not ready to buy yet because the wind is against us. The wind's blowing in our face and is against us. And we want to wait for it to turn and then be pushing on our back. The wind's on our back. And then we can look to enter. So we're going to go to a candlestick chart up here. We're going to now zoom in. And what we're going to do is, because we got the momentum now, the bullish reversal, the entry strategy is on the 1 bar high, on the previous bar high, we can put in an order to say we're happy to go long on the 1 bar high, right? So what we do here, even if we zoom in a bit more, I'm going to zoom in a bit more, bang. We're going to get really, really clear on this, really clear, really objective. We're going to risk a little to potentially make a lot. So what we say is we want to go on this 1 bar high. The actual price of this high, if we look up here in the top left-hand corner where it says H stands for high, is we click, if we find it difficult to get the top of the bar, you can click this magnet on the left and it helps us just click the top. It says 104.82. That's the high. That's where we want to buy, right? That's where we want to buy. Now, this is, you have to obviously do your own research, but we want proper risk management. But where's the low? Well, the low is down here, right? So again, we want to click this low. The low is, oh, let me just make sure I got it. Bam, bam, is 86.06, right? This basically counts for our risk, right? I'm gonna get some objective information for you. So this is our risk. I'm gonna draw it like this actually, right? This is our risk. This distance is our risk. I'm gonna use the spreadsheet that I put together to help us with this, to do the numbers, because sometimes numbers can be confusing if you don't know what you're doing. And then what I'm gonna do is I'm gonna zoom out back to normal, like this, because I want to give you a visual, right? You risk a little to make a lot. It means you, and hear my words, probability is never certainty, so there is risk. So there's risk of losing this amount, but we're gonna see the business thinking now, the objective mechanical numbers, right? So now that pink box looks tiny, and now we're looking to capture most of this move. This is what we're saying. We anticipate Solana to do this much, but to find out if we're right, we have to risk this much. If we're right, we make this much. If we're wrong, we lose this much, right? That's the logic. That's, you risk a little, and this is the 18x. This is the 1x risk, and this is 18 times that. That's basically 18x. And then I think I might have taken it as this one though, this, because Solana in the last run, in the last bull run, in the last move here, this was the 2.618. 2.618 was the movement of the previous wave one. So we should anticipate that it's probably going to do a similar thing. So now what we're going to do, and I'm doing it step by step. And by the way, if you've got my course, if you've bought my course, whether you bought it last year or yesterday, there's a new section called risk management, and I've added what I'm about to show you in a second. So what we want to have is this price here. This 104.82 is the buying price, and what we call the stop loss, the sell order, if we're wrong, which basically means this. If the price does this, and then all of a sudden we want to be aware that there's still a possibility it might do this, and we haven't moved anything, we take a loss. That's just the name of the game. Taking a loss is the cost of doing business when it comes to trading. So here what we're going to do is just going to make a note of these numbers, 104.82. So we're going to jump into this spreadsheet, right? First, you're going to put in your account size. So whatever your account size is. Is it 20 grand? Is it 50 grand? Is it 10 grand? Whatever it is, right? Let's just say it was 30 grand, right? So you got 30,000 USDT or US dollars. Your risk, how much are you willing to risk per trade? Now, the top traders on the planet, especially when you've got big, large accounts, risk between 1% to 3%. Yeah, they risk 1% to 3% per trade. And the thinking is probabilities, never certainties, right? So I'm willing to risk 3% to potentially make 50%. But I know there's going to be times, 30, 40, 50, 60% of the time when I'm wrong, and I'm going to take a small loss or break even or to have a small profit. And when I'm right, that's when I make my money, right? So here we're using 3%, which is actually more on the aggressive side, believe it or not. When we're doing pure trading here, this is really, really important. Entry, what did we say? Now, again, we go back here. We said 104.82. I like to add 5 cents on top of that, 5 cents. So it just means that the wind is really in our sail. So we're going to write 104.87. 104.87. 104.87. And you'll see this spreadsheet is dynamic, so it's going to move around the numbers. We say the stop loss, which is basically if we get triggered into the trade and it doesn't go our way and we get stopped out, which is absolutely a possibility, the stop loss is at 86.06. Again, we're going to minus 5 cents, so it's going to be 86.01. 86.01, because sometimes you just want to give it a little more room, 86.01. Because sometimes it will get close to being stopped out. But if you get your stop too close to the low, just give it a little extra room. And sometimes it will just, 5, 10, 20% of the time, it will make a big difference. So basically the difference between these two is $18.86, right? There's a math I've put into this spreadsheet that you don't need to concern yourself with too much. But what this basically tells us is if you got $30,000 account, 3% of 30,000 is $900, right? Hopefully that's making sense there. So again, so basically what we're saying, we've got $30,000 in this example. Again, you can change the number, whatever your number is, times 0.003, which is 3%, is, let me do that again, times, so 0.03, 0.0330, yeah, sorry, 0.03, there you go, is $900. Yeah, so that's 3%, that's the math, right? So we're happy risking $900 to find out if we're right, but we also want to know if we are right, what does the P&L look like? What does the end result look like? What does the roadmap look like? What's the business plan? Why would we risk 900? Because we don't want to risk 900 to make 990, which is like $90. We want to risk $900 to make a potential $9,000, right? That's the thinking. So now we're going to go down here. This tells us down here, let me just pull this up. Based on your risk, you can buy 47.72 Solana tokens. The cost is going to cost you, because we're not using leverage here, is going to say that's going to cost you $5,000. You go, wait, hang on a second, Jagir. $5,000 is a lot more than $900. Yes, that's true. So this is where it comes in. So we're happy selling those 47.72 tokens at the stop loss price at 86, and the money we'll get back is 4,104. So we're selling at a loss, and this basically says our risk is $900, right? Just so we're on the same page, because if you're not used to this. If you're used to this, this is going to be, easy. If you're not used to this, then this is new information. We're saying we're going to spend $5,000. Now you can use something called leverage, but for now, let's just ignore that. We want to just use no leverage, right? And it says, right, but if we sell at a loss of 4,104.4, it means we've lost $900. So even though we're buying $5,000 worth of tokens, that's what it's going to take to have a full position size and the full risk that we need. You're going to take a potential loss of 900. Hopefully that makes sense, right? In the top right-hand corner now we're going into the trade management section. So we're saying here, we want to assume that we're wrong, right? So at what we want to have we call it a 2-unit exit strategy. The first unit, or the first part of like half of your tokens, you have to decide what this is. But in this example, we're using 50% of our tokens. We're saying that there's going to be we're going to jump into the chart in a second. At a certain point, when Solana does the minimum expectation, if we're wrong, we want to sell some tokens or move our stop loss. And this is going to help us manage how many tokens and at what point. And then exit 2 is going to be for the bigger degree move, right? We want to ride most of that wave 3 if we can, right? And again, we have to make some decisions, but most of it's going to be mechanical. So now we're going to jump back into Solana in the chart to fill out these two parts here. This part here, this exit 1 target zone and the exit 2. So the only information that you're inputting is the yellow boxes. Everything else is dynamic. So now let's just jump back into the chart. So what we need exit 1. So the thinking we need to get into, and we did this yesterday with Cardano, is if we get triggered into this entry, into this position, we want to go, okay, what's the minimum expectation that we have? Okay, well, after a 5-wave sequence, like we said at the beginning, and it's the same is true for the opposite. After a 5-wave sequence, 1, 2, 3, 4, 5, we should anticipate a minimum of an A, B, C. Even if we are expecting because what people don't realize, and they lose sight of this is so important, is when you are anticipating a wave 1, a wave 2, and the beginning of a wave 3, at this point, we actually don't know if it is an A or a 1, a B or a 2, or a C, or the beginning part of a 3. We don't know. And it's best practice to assume the worst case scenario, to say, okay, let's just assume it's a C. Let's get risk-free over here. So we exit half or 20%. You have to put that in your business plan in advance. And if we're wrong and the market does this, we make money. All right? You make money when you're wrong. And if you're right, you make a lot of money, right? So that's the key thinking, because when Warren Buffett says, rule number 1 is never lose money, and rule number 2 is don't forget rule number 1. It's like, what does that mean on a practical level? Well, this is what we're talking about on a practical level. So now what we're looking at here is this 5-wave sequence to the downside. Let's just go back to our line chart. This here, we got a 1, 2, 3, 4, 5. Now, if we just look at that independent from all the macro picture, let's say we're not aware of there's a wave 1, there's a wave 2. All we know right now for our first position is we got a 5-wave movement to the downside. If we got a 5-wave movement to the downside, what's the minimum anticipation on the upside? Well, it's 3 waves as a correction. That's what we want to be thinking. So all we do is simple. It's very, very simple. You just take the high to the low. Bam, and the 3 ratios are 50, 62, and 78.6%. We want to do time. How long does that normally take to form as a minimum? We'll be a bit more conservative and we'll go bang 50%. All right, so now we've got a price and time zone as our minimum target. So the minimum target here is 50%. Now, this number may change. What we're going to do is the following. We're going to use the momentum indicator, right? The momentum indicator is going to help us make objective mechanical decisions. Because we're anticipating 3 waves, we let the daily momentum go up, overbought, that's fine. We let it go down. And then on the next wave, where it gets into the overbought zone, we then want to evaluate the price. So we need to give it 3, 4, 5, 7 days. And you have to give it space. Give it space, because you don't want to you can't rush these things. The psychology needs space to play out. And then what typically happens with the price, if it does reverse and triggers us into the position, is you get something like this, you'll get something like this. And at this point, when I get this, come on, let's go. At this point, when we go here, and the next wave, if it does occur like this, at this point, we do not know. And it's important to know that you don't know. Because when you know that you don't know, then you do. That's some Zen Buddhism for you. Yeah, when you know, then you don't. When you know that you don't know, then you do. So we need to know that we don't know. Right? I know that's a bit of a tongue twister there. But we don't know if this is a wave 1 or A, 2 or B, or the beginning of a wave 3 or a C. So we assume the worst case scenario, which is, let's assume this is a correction. For whatever reason, it's a correction, right? Yeah, but you get Solana, bullish news, wave 2, 1.618. Let's just make the millions. I go, yeah, calm down. Let's just do Warren Buffett, right? Rule number 1, never lose money. So if the price target hits this, then we want to exit half, right? Just keep it simple, keep it mechanical. You can adjust the numbers that suits you. So for now, let's just keep the number for our business plan. Let's be conservative. Let's just say our exit 1 is at 14276. 14276. Might be higher, might be lower, but 14276. So when we jump back into the spreadsheet, we go exit 1 target, 142.76. Bang. Right? And this is, we're going to go over these numbers in a second. Right? So now we go, that's position 1. That's our risk-free position. That's our protecting our capital with our life. We go, we don't give money back to the market. We protect our money. And what we're also going to do, keep in mind, it's not in the spreadsheet, but you can add it into your business plan, is this stop loss. When you exit position 1, as a minimum, the stop loss that you have, let me do it like this. Bang. The stop loss that we have, which is this here, this is our stop loss down here. We move it at least to the entry point or the previous swing low down here, right? If it's an obvious swing low, it goes here. If it's up here, we go, look, we don't give money back to the market once it's moved in our direction. So if the market does reverse, and stops us out, the second position is either a small profit or break even, and the first position is 100% profit, right? So if we said, okay, our entry point, again, I'm trying to get a thinking across, because what I found is most people's thinking is not on point. We need to get it on point. Let's just say the entry point was 104.87 and the second position is exited at 104.87. So that means even when you're wrong, you've still made 20% of your whole portfolio. You've still made, like, you risked, because you bought, where is it here? Yeah, you've risked this much and you've made like $900, right? So it's not bad, right, for being wrong. But if you're right, then it's a different ball game, a very different ball game. So what we're gonna do now is we are gonna jump into. Sorry, you've made. Let me just double check this. Yeah, that's all right. You would have made like a 6x. You would have made. Let me just double check my math. Let me just see. Just want to double check. Bang, bang. Yeah, perfect. Yeah. You would have made, the main lesson is you would have made money if you're wrong. Now, what if you're right? But we only look at that really once the market's taken off. So we got our first position, that's sorted, trade management, yeah, risk-free, we got that clear. Now what we're going to do and finish up on is this part of the thinking. As we go, okay, we've been very cautious. Warren Buffett will be proud of us. He'll be like, hey, never lose money, risk management, that looks good. I know he's not a technical trader. He's more of a fundamental trader or investor, but the math is there, right? So we go, we're happy with that. Then the second phase is part 2, position 2. How do we manage position 2? We go, well, we're looking for a 5-wave sequence. So now let's just get rid of these lines. Get rid of these lines. Get rid of these lines. And we'll leave that there. So what we're going to look for now is something similar that we saw down here. Right? We saw this amazing wave 1, wave 2, this impulsive wave 3, 4, and 5. And then a nice ABC correction. So now we're going to expect some type of 5-wave sequence. And we're looking for that 5-wave sequence. So what we look for is simply something like something like this. Intermediate, bang. Yeah, we have to let it play out, but this is what we're anticipating. So we're looking to get risk-free in this zone. That's risk-free. Let me just do that as a visual as well. We're going risk-free. Exit 1. Bang. Right, that's what this is. And then here, we're looking to, every time we've got a new swing high, we move the stop loss. It's called trade management. We move the stop loss. When you got another swing high, you move your stop loss. You're literally moving your stop loss as you get new swing highs. And then when we approach a 5-wave sequence, a 1, 2, 3, 4, 5, we will project more accurately where is the high probability end of wave 5 of a wave 3. Now, it might be higher, it might be lower. We have to evaluate as the price data is there. We don't have that information right now. But let's just say we knew it was coming towards that zone and the price is doing this and we're in really great profit. Then what we do is we trail the stop on a 1-bar low, similar to the entry, but now the reverse, because we want the wind is in our favor. The trend is our friend. We want to ride it until its end, and we want to let the market take us out. So the wind is pushing our sales forward, and we go, we don't want to jump the gun. We don't want to just press sell. Let's just see how far this boat wants to take us. Let's go, let's go, let's go. So we just literally go, bam, there's a stop loss. Next day, we move it up a bar. Next day, we move it up a bar. And like with many markets, Solana also in particular, especially with wave 3s, we might get this explosive movement to the upside. Explosive, like panic buying, right? Positive news comes out, bang, one day bar, one day bar, one day bar. And then at this point, let's just say it was a wide bar and we put our stop loss here. And then we get the first movement against our sell, bang, there's our stop loss. So then our second unit, in this example, I'm just kind of trying to get the thinking across to you, we would have made this much distance, if that makes sense. So now we can just put in the number. So again, we can be a bit more conservative, but let's just do it like this example. It says 601.22. So we just pop that into the spreadsheet. Exit 2 is 601.22, 601.22. Now all of a sudden, we've made $17,000 gross, right? $17,000 gross. Our initial risk over here, if I can just draw this, was $900. The potential exit that we've just drawn for the 2 exits is 17,700. The risk reward is 19.7x in this example, meaning we risked 900 to make 17,000. So when we do the math, we go, again, we haven't made the money yet, so this is just the business thesis, this is the thinking, and you want to plan this in advance. You go, is this a good trade setup? Does this hang together? Is it a high probability? All right, now let's assume we're wrong. Exit 1. Now let's assume we're right. Let's ride the wave and give it space and let the weekly momentum get overbought. And it might be 2, 3, 4, 5, 6 weeks that you're holding the position and just managing the stop losses. And then we have to manage it as we go on. And if we get stopped out early, we can reevaluate to see if there's another entry point and so on and so forth. So if we do this amount divided by our initial risk, which we saw at the beginning, is 19.7x. 19.7x. So what that means is when we say 59%, what does that mean, Jagir? 59%. Well, we're saying our portfolio at the beginning in this example, this case study, so to speak, is $30,000. You put in your number here, whether it's 10,000, whether it's 100,000, whether it's a million, right? We're risking 3% per position. And we're saying if this trade goes our way and we get our 2 exits as planned, then we will make a total of a dollar amount, 17,751. And if we divide that by our total capital is 30,000, then that's 59%. That's what that means. Times 100 is 59%. Times 100 is 59%. So, but then that capital adds. So now if there's a successful trade, we go, now our total portfolio that's liquid, as in that's not in positions, is going to then be 17,751. It's going to be 47,751. Now, 3% is no longer 900. 3% is now 1,432, right? And you only ever want to be into, maybe 3 positions at any one time, 3 open positions that have risk and the stop loss hasn't been moved and the exit one hasn't been exited, and then once we reach exit one on Solana, then you can look to take another position in, I don't know, whatever coin that you're looking at. Hopefully that makes sense. Right? So now let's just wrap up with any other things. So if you've got my course, if you haven't got my course, take my free Elliott Wave and Fibonacci Masterclass, because it gives you a flavor of what's in the course. And if you like it, buy the course. It's cheap as chips. I made it incredibly affordable, and then you'll get this. This has now just been added. And if you have got my course, it's in the back end. I added it this morning because we just want to make sure you have the tools that's going to allow you. It's only the yellow boxes that you should change the information for. And again, we'll update this as we get, I'm kind of listening to your feedback also. So now let's just do one last thing. Is there anything else? No, we got it. That was it. Simple, easy, A to Z, mechanical, objective, non-emotional. Let's go with the flow. The trend is your friend. Ride it until its end, until it reaches its bend. Like, subscribe, hit the bell notification. Let's finish with our daily quote. What's today's quote, Jagir? It is Henry Ford. Henry Ford. It has been my observation that most people get ahead during the time that others waste. Hey, look, I'm focused on this bull run, but I'm also focused on the next bull run. 2024, 2025, 2026, right? When the next Bitcoin halving occurs. This market's here to stay. It's reached at peak $3 trillion market cap. It's more than likely going to be $10 to $20 trillion over the next 3 to 5 to 10 years. So it means there's going to be a lot of opportunity, a lot of buying opportunities, a lot of ABC corrections, a lot of wave 3s, a lot of wave 4s. There's a lot of coins. And to be honest, often, I don't really care what the coin is. Like if it's doing an ABC correction, like if it's Solana or if it's Cardano, like some of them I know a lot about, some of them I know a little about, but I just look at the technicals, the fundamentals are baked in, and it's objective, it's mechanical, it's non-emotional. You don't need to get too caught up in the news, in what's happening, the roadmap, the team, the tokenomics, and everything else. Those things count, but the technicals bake it all in. It's almost like the shortcut guide, and it's clean, no noise, no noise. So if you like today's content, like, subscribe, hit the bell notification. Let me know how you found today, because I'm trying to kind of get the probability in your favor, but now go beyond just words and make it practical. Because I know words, probabilities, never certainties, the trend is your friend, and so on and so forth can be nice words, but it's like, how do we put that into execution? How do we make it mechanical? How do we actually execute on that on a consistent basis so we win, win, win? All right, keep winning, and I'll see you soon.